Subscribe to our channel and click on the bell button to receive important financial updates faster than anybody else.
Friends, welcome to another video on your channel Profit in Equities. Considering the recent volatility in the stock markets, investors need to look out for quality stocks with earnings visibility, superior management and low operating margin variability. In this video, we'll be talking about 5 fundamentally strong stocks which can be accumulated in weak and uncertain markets as they meet all these criterions. Now these are part of HDFC Securities research and were disclosed as part of an interview on a financial news channel. We will be providing a link to the article in the description section. Please watch this video to know more. Now the first stock on the list is Mahanagar Gas Limited, which is available at Rs 817.15 and the face value for it is 10. The symbol for it is MGL. Now Mahanagar Gas Limited is a city gas distribution company. The company is engaged in the distribution of compressed natural gas and piped natural gas in Mumbai and its adjoining areas in the Rico district of the state of Maharashtra. It also supplies CNG for vehicles including rickshaws, taxis and cars in Mumbai, Thane, Mira Bhayandar and Navi Mumbai. Now monopolistic nature of the business and ramp up in new geographies would drive volume growth in the coming years. Better economics of compressed natural gas and piped natural gas in the era of buoyant crude price regime and maintained spreads are tailwinds for the company. As is evident from the one-year chart, the company has been an underperformer throughout the entire year and a lot of wealth has been lost here. The company is a mid-cap with a market capitalization of 8,071.63 crores. The EPS of 48.78 translates into a price to earnings ratio of 16.75, which is much more cheaper when compared with the industry PE of 22.83. The price to book ratio of 212.13 translates into a price to book ratio of 3.85, which is slightly expensive. The company has a strong dividend yield of 2.33%, whereas the promoter holding is above average and stands at a figure of 56.50%. The 52-week high is 1377.50, whereas the 52-week low for this stock stands at a figure of 760.55. The second stock on the list is Rico Auto Industries Limited, which is available at Rs 68.85 and the face value for it is 1. The symbol for it is RICO-AUTO. Now Rico Auto Industries Limited is engaged in the manufacturing of clutch and crankcase. The company is engaged in the manufacturing and sale of auto components for two-wheelers and four-wheelers. It manufactures and supplies high precision and machined components and assemblies, both aluminium and ferrous, to original equipment manufacturers. Now post its split with FCC in 2015, Rico Auto has changed its strategy and now caters to PV and CV markets in addition to two-wheelers. Strong order book of Rs 4,800 crores, capacity expansion, increasing volumes in alloy wheels and changing product mix are expected to improve the operating profit margin. Rico is in the process of launching 3 more products and improving profitability, which may help it get re-rated to a PE comparable with other auto ancillary companies. Now, as is evident from the one-year chart, this company has also been an underperformer and a lot of wealth has been destroyed here. The company is a small cap with a market capitalization of 931.44 crores. The EPS of 3.83 translates into a price to earnings ratio of 17.98, which is much cheaper when compared with the industry PE of 20.05. The book value of 40.23 also translates into a reasonable price to book ratio of 1.71. The company has a dividend yield of 1.16%, whereas the promoter holding is just about average at 50.07%. The 52-week high is 110.90, whereas the 52-week low for this stock stands at a figure of 64.55. This indicates that this company is pretty close to its 52-week low. Now the third company on the list is Engineers India Limited, which is available at Rs 118.90 and the face value for it is 5. The symbol for it is ENGINERSIN. Now Engineers India Limited is an engineering consultancy and engineering procurement and construction company in the hydrocarbon and petrochemicals industry. The company's segments are consultancy and engineering projects and turnkey projects. Now, as is evident from the one-year chart, the company went on a spike for the first few months of the year, but since then has had a steep decline. The market cap of the company is 7,513.43 crores, which indicates that this company is a mid-cap one. Now, Engineers India Limited is likely to benefit from the expected capex in the hydrocarbon and petrochemicals industry as it is a market leader for consultancy. It's a debt-free company with an order backlog of Rs 7,229 crores, which is close to 3.5 times book to bill. With a healthy cash balance of Rs 2,500 crores, it may reward shareholders through another buyback or special dividend. Now the EPS here stands at 6.06, which translates into a price to earnings ratio of 19.62, which is largely in line with the industry price to earnings ratio of 19.55. The book value of 35.89 also translates into a not very expensive price to book ratio of 3.31. The dividend yield here is a very strong number at 3.36%, whereas the promoter holding is just above average at 52.02%. The 52-week high stands at 206.40, whereas the 52-week low for this company stands at a figure of 116.10. Now the fourth stock on the list is Sun Pharmaceutical Industries Limited, which is available at Rs 623.25 and the face value for it is 1. The symbol for it is SUNPHARMA. Now Sun Pharmaceutical Industries Limited is a pharmaceuticals company. The company's business segments include US business, Indian branded generic business, emerging markets, global consumer healthcare business, and active pharmaceutical ingredients. Its rest of world segment includes Western Europe, Canada, Australia, New Zealand, and other markets. Now, as is evident from the 1-year chart, the company was consolidating for the first few months of the year, but since then has been on a slight uptrend. This company has also been very positively impacted by the rise of the dollar against the rupee. The market cap of the company is 1,49,537.91 crores, which means that the company is a large cap one. The EPS of 15.95 translates into a price to earnings ratio of 39.60, which is much more expensive when compared with the industry PE of 31.31. The book value of 157.4977 translates into a price to book ratio of 3.9572, which is also on the higher side. The company's dividend yield is 0.32%, whereas the promoter holding for this stock stands at a figure of 54.38 and is slightly above average. Now, Sun Pharma is amongst the few companies in India to have made large upfront investments in US specialty. Operating profit margins are expected to improve on the back of key drugs launch and moderating price erosion in the US. The company has 422 approved patents in US and 139 pending for approval. Ramp-up of generics and specialty business driven by increased investments augurs well for the company as it improves its launch visibility. Now the final stock on the list is Axis Bank Limited, which is available at Rs 613.25 and the face value for it is 2. The symbol for it is AXISBANK. Now Axis Bank Limited provides a suite of corporate and retail banking products. The bank's segments include treasury, retail banking, corporate wholesale banking, and other banking businesses. Now, as is evident from the 1-year chart, the company had a spike about a couple of months into the year, then consolidated, and of late it has had another spike. The market cap of the company is 1,57,550.99 crores, which means that the company is a large cap one. The company has had losses recently, and hence the EPS and price to earnings ratio are not applicable here. The book value of 246.96 translates into a price to book ratio of 2.48, which is slightly on the higher side. The industry PE is 31.62. Now the company did not pay out any dividends and the promoter holding here stands at a figure of 25.15%. Now Axis Bank has made significant investments to ride the next growth cycle with strong capitalization and an expanding liability franchise. The worst seems to have been priced in and the bank is available at attractive valuations as compared to other similarly placed peers. The new CEO could bring in a fresh perspective to the bank's growth plans. Now, beside the stock ideas that were discussed, there was also an important thread around how this current rally compares to the one in 2008. Here, it was categorically stated that the situation is now different compared to 2008. Then, there was a massive inflow from FIIs which led to most scripts doing well, whether with or without merit. Regulation at that point in time was not as strict as now. In the current circumstance, only companies that have passed the test of demonetization, GST upheaval, SEBI diktat and debt repayment capacity have done well. Quality has become more expensive with investors fearful of taking a bet on commodity companies as well as companies that do not have any moats. Disruption in a whole host of sectors has resulted in uncertainty on business models of some companies and difficulty in predicting earnings trajectory of quite a few companies. Further, PSU as a sector continues to underperform due to the fact that minority interests are not always kept in mind while taking policy decisions in these companies. Investors have also become choosy about governance and capital allocation decisions made by the company's management. Many small cap and mid cap companies may fail the test of survival in an era of constant disruption, either due to regulations or technology. Now friends, please don't consider this to be a recommendation on our part. Please go ahead and do your own research. These stocks were disclosed as part of an interview on a financial channel, and we will be providing a link to the interview in the description section. Please go through it to build more conviction around your investment decision. Thanks for watching, and if you have not yet subscribed to this channel, please consider doing so.